We have officially crossed into territory that most traders will never see in their lifetimes. For months, the warnings were clear. The silver market was operating on borrowed time. The paper price quoted in New York was becoming increasingly disconnected from physical reality. Digital contracts were being traded by algorithms that had lost touch with what was actually happening in the real world. The prediction was simple. When the breaking point finally arrived, it wouldn't be gradual, it would be catastrophic. Monday, January 12th, 2026, was that day. The dam didn't crack. It shattered completely. Silver on the COMEX touched an all-time high of $84 per ounce during the early session. Currently, it's fighting to hold around $82.79. That represents nearly a 4% move in a single trading day. In precious metals markets, moves of this magnitude typically unfold over weeks or months, not hours. But if you're only watching the New York price, you're missing the most critical data point. You're missing the number that explains why the traditional market controls have failed. While Wall Street stares at $82, searching for resistance patterns and double tops, looking for any excuse to justify selling, the Shanghai Gold Exchange just fixed the price of silver at $91.13. Let that number sink in for a moment. $91.13. There is now a $7 spread between the price of silver in Western markets and the price of silver in Eastern markets. This isn't an arbitrage opportunity in the traditional sense. This is a structural fracture in the global pricing system. This is the physical market in Asia screaming that the paper market in New York has become insolvent. When you witness a gap of this magnitude, you're watching a pricing mechanism die in real time. The COMEX is trying to tell the world that silver is worth $82. Physical buyers in Shanghai are paying $91. Which price reflects reality? The market built on paper leverage, or the market where actual metal changes hands? Physics always defeats fiction. The law of arbitrage is absolute. If silver truly costs $82 in New York and $91 in Shanghai, every rational trader on the planet will buy in New York and immediately sell in Shanghai, capturing that $9 spread as pure profit. This process continues relentlessly until either New York's price rises or Shanghai's falls, or until the Western vaults run completely empty. That mechanism is what forces the squeeze. The New York price must rise to meet Shanghai. There's no alternative. Economics doesn't bend to wishful thinking. Let's examine Monday morning's price action in detail, because the chart reveals something that professional traders recognize instantly. The session opened at 80.69. There was a brief dip to 79.95, and then something extraordinary happened. The price didn't climb gradually, it teleported to $84. This vertical move is identical to what occurred in the nickel market in March 2022. A massive commercial short seller found themselves trapped on the wrong side of a geopolitical shift. The price went vertical. The exchange mechanisms broke down. Trades were canceled. We're witnessing the early stages of that exact pattern unfolding in silver right now. That vertical spike on the chart represents a crime scene of sorts. It's the footprint of forced buying. Somewhere in the complex plumbing of the financial system, a massive entity, most likely a bullion bank or a major industrial hedging fund, exhausted their collateral. They had established short positions at $75. When the Shanghai price hit 91, their risk management model detected impending disaster. The clearinghouse computer systems took control and executed a massive market buy order. It purchased at 81, it purchased at 82, it purchased at 83. The buying didn't stop until the price reached $84. But we need to remain analytical even in the face of this volatility. Look closely at the candlestick pattern. There's a wick extending upward from the high. The price touched 84 and was immediately pushed back down to 82.79. Mainstream financial media will characterize this as rejection. They'll claim the rally is exhausted. They'll insist that smart money is taking profits and exiting positions. That narrative is completely false. That wick doesn't represent profit-taking. It represents desperation. It's the last stand of the remaining short sellers. They're defending the $85 level with everything they have, because they understand that if silver closes above 85, while Shanghai trades at 91, their positions become mathematically insolvent. So they're deploying every paper contract at their disposal. They're selling futures contracts they don't actually possess, trying to paint the chart red and trigger fear-based selling from momentum traders. But look at the actual result. Despite maximum effort, despite massive selling volume, the candlestick closed green. The trend remained upward. The lows are getting progressively higher. This confirms that the suppression algorithm has broken down. Think back to December. When they hammered prices lower, the decline persisted for an entire week. Markets were trained to expect that pattern. But today, they smashed the price and it recovered within an hour. The law of diminishing returns has caught up with the manipulation infrastructure. The Monday morning gap deserves special attention. Gapping upward through an all-time high on a Monday morning is a very specific technical signal. It means news, developments, and pressure accumulated over the weekend while markets were closed. The The Shanghai premium, industrial shortage concerns, geopolitical tensions, all of it built up pressure. The moment trading resumed, that pressure released explosively. This creates a psychological crisis for everyone holding cash on the sidelines. If you've been waiting for a pullback to $75 before buying, you're now realizing that pullback might never materialize. You're staring at $83 and feeling the acute pain of missing out. This fear becomes fuel for the next leg of the rally. It's called a chase. Investment funds that are underweight silver relative to their benchmarks are forced to chase the price higher because they cannot afford to underperform. Portfolio managers don't get rewarded for being right eventually. They get evaluated on quarterly performance. Missing a 10% move in a major commodity creates career risk. But here's a crucial warning. In vertical markets, volatility becomes the weapon of choice for institutions trying to maintain control. They cannot stop the price from rising ultimately, but they can make the journey incredibly painful for traders using leverage. It's highly probable that we see a violent flush sometime this week. They might successfully drive the price back down to test $79. If you witness silver drop $5 tomorrow, do not panic. Do not liquidate physical metal holdings. A drop to 79 would simply represent a backtest of the breakout level. The market would be checking whether the floor is solid. That's healthy. That's normal technical behavior. However, given the $7 Shanghai premium, there's a very real possibility that the backtest never happens. We might simply continue climbing. We might see limit-up trading days where exchanges halt activity because price movements exceed their systemic controls. Your mindset needs to fundamentally shift. You're no longer trading a predictable, range-bound market. You're witnessing the early stages of a currency reset in real time. When you see silver at $84, don't think silver has become expensive. Think the dollar has become broken. You're watching the purchasing power of fiat currency evaporate. The chart of silver is simply the inverse chart of dollar credibility. Right now, with Shanghai paying $91, the credibility of the COMEX pricing mechanism is effectively zero. The disconnect between screen price and street price has become undeniable. If you call a bullion dealer today attempting to purchase silver eagles, they will not sell them to you at $83. They'll quote you $100 per coin, or they'll inform you they're completely out of stock. This is what a physical default looks like as it unfolds in slow motion. The price displayed on financial websites represents paper contracts. The price you actually pay to hold metal in your hand is something entirely different. That spread is widening every single day. The technical verdict is clear. The market has transitioned from accumulation phase to vertical liquidation. We've broken through the $80 ceiling, we've touched 84, and we have a massive magnetic force at $91 pulling prices higher. The banks are fighting a battle they cannot win. They're trying to hold a beach ball underwater using a toothpick. They might succeed for brief moments. They might paint a red candlestick on the hourly chart. But the underlying physics of the market, the arbitrage dynamic between East and West, is relentless and unforgiving. While algorithms in New York were fighting over fractional price movements on paper contracts, a very different and far more consequential conversation was unfolding in the boardrooms of the world's largest manufacturing corporations. The distinction between the paper game and the physics game has been discussed extensively. On January 12th, the players of the physics game just flipped the entire table. To understand why silver isn't crashing back to $60, why the $84 level is acting as a floor rather than a ceiling, you need to put yourself in the position of a procurement officer at Samsung or Tesla. You're not a day trader. You don't care about Fibonacci retracements or moving averages or technical chart patterns. You have one singular job: ensure that the assembly line never stops running. Samsung has committed billions of dollars to mass production of solid-state batteries. These next-generation batteries utilize a silver-carbon nanocomposite anode. This isn't theoretical chemistry. This is the actual manufacturing reality of production facilities already built and operating. The factories are constructed. The precision tooling is installed. Supply contracts are signed with automotive manufacturers. Production targets are locked in. But a critical problem emerged over the weekend. Those contracts were negotiated based on assumptions about available supply. The assumption was that London vaults contained adequate metal. The assumption was that the COMEX could facilitate delivery. The assumption was that the just-in-time supply chain model would continue functioning normally. When the price gap opened Sunday night, when Shanghai fixed the price at 91.13 Monday morning, every one of those assumptions evaporated simultaneously. Imagine being the Samsung executive responsible for securing silver supplies. You see the Shanghai price at 91. You see the New York price at 82. You understand logistics well enough to know that every unallocated ounce of silver on the planet is currently flowing toward Shanghai to capture that $7 arbitrage profit. The metal is moving east. It's leaving the Western Hemisphere. If you don't act immediately, if you don't bid substantially higher than $82, your factory in South Korea or Nevada exhausts its raw material inventory within weeks. If the factory runs out of silver, the assembly line halts. If the line halts, you miss delivery commitments for new electric vehicle fleets. If you miss those commitments, your stock price collapses and you lose market share to Chinese competitors who, let's be brutally honest, secured their silver reserves years ago when prices were suppressed. So what do? Do you wait for a better chart setup? Do you hope the price dips and technical support levels hold? Absolutely not. You panic buy. You pick up the phone and call mining companies directly in Mexico and Peru. You tell them to forget the COMEX, forget the London fix. You'll pay $85 per ounce right now, cash on delivery, if they ship the concentrate directly to your refinery, bypassing all traditional market channels. This phenomenon is called ghost supply. It's metal that bypasses public exchanges entirely. It never touches COMEX warehouse inventories. It never appears in official statistics. To outside observers, it looks like supply is mysteriously vanishing. In reality, it's being privatized by industrial giants terrified of production shutdowns. This creates what economists call price inelasticity. Mainstream financial analysts, the same ones who declared silver was a bubble at $50, operate on the assumption that as price rises, demand falls. That's true for discretionary luxury goods. If a designer handbag doubles in price, consumers purchase fewer handbags. But silver isn't a handbag. It's a strategic industrial component with no viable substitute. Let's examine the actual mathematics of a solid-state battery. Suppose each high-performance battery pack requires 50 grams of silver. At $60 per ounce, that represents roughly $100 worth of silver per vehicle. At $84 per ounce, that rises to approximately $135 per vehicle, a $35 increase. Does a $35 raw material cost increase prevent someone from purchasing a $50,000 electric vehicle? Of course not. It's a rounding error in the total cost. The automaker can absorb that expense or pass it along to consumers without meaningfully impacting demand. But here's the critical point. They cannot build the car without silver. There is no substitute material that conducts electricity with comparable efficiency. There is no alternative battery chemistry that works at scale, so demand doesn't decline when the price hits $84. Counterintuitively, demand might actually increase. Why? Because the fear of unavailability now outweighs concerns about higher prices. Samsung would rather pay $100 per ounce and keep production running than pay $80 per ounce and watch assembly lines sit idle. Tesla faces the same calculation. Every major electronics manufacturer faces this same brutal arithmetic. This industrial panic creates a floor under the market that no amount of paper contract selling can penetrate. Banks can short millions of ounces on futures markets attempting to suppress prices, but they cannot manufacture physical silver bars for Samsung's factory floor. Samsung needs actual atoms. Tesla needs atoms. Solar panel manufacturers need atoms. And right now, atoms are flowing to the highest bidder, which happens to be Shanghai at 91.13. This dynamic effectively places a put option under silver prices. It means that if the price somehow drops to $78, industrial buyers will immediately step in and purchase every available ounce, because to them it represents a discount on critical survival material. We're witnessing the industrialization of silver's monetary premium. For thousands of years, silver functioned as money. Then for roughly 100 years, it was treated as merely an industrial commodity. Now it's both simultaneously. It's a monetary asset being squeezed by industrial necessity. And we haven't even addressed the military dimension yet. Look at the geopolitical headlines from the past 2 weeks. The temperature is rising. The U.S. military operation in Venezuela on January 3rd required massive logistical support infrastructure. Modern warfare is electronic warfare. Every guided missile, every reconnaissance drone, every satellite communication system, every radar array requires silver. It's the most electrically conductive metal in the known universe. You cannot fight a technologically advanced military campaign without it. The United States Department of Defense does not maintain a strategic stockpile of silver. They liquidated those reserves decades ago. If conflicts expand or intensify, the Pentagon becomes another inelastic buyer competing for the same finite supply. Do you think military procurement officers care whether silver costs $84 or $184 per ounce? They have effectively unlimited budgets backed by monetary creation. They'll pay whatever it takes to secure the conductive components for weapons guidance systems. National security considerations override price sensitivity every single time. So you have Samsung competing with Tesla, competing with the Pentagon, competing with the Reserve Bank of India, competing with Chinese industrial speculators. All of them are chasing the same shrinking pile of physical metal. And positioned in the middle of this struggle are the commercial banks on the COMEX, holding massive naked short positions, desperately hoping the price declines so they avoid insolvency. It's not a fair fight. The banks are standing on railroad tracks, trying to stop a freight train using a piece of paper that says, "Stop." The train doesn't care what the paper says. This brings us to a critical bottleneck that most analysis completely overlooks: the refinery constraint. Even if silver continues being extracted from the ground, and remember, global mine supply has been flat or declining for years, that metal must be refined. Raw doré bars from mining operations must be processed into 0.999 fine industrial bars that manufacturers require. Refineries operate at maximum capacity. You cannot simply increase production by flipping a switch or working harder. Refining requires time, enormous amounts of energy, specialized equipment, and skilled technicians. We're hearing reports, currently unconfirmed but consistent with observable data patterns, that major refineries in Switzerland and Canada are fully booked for the next 6 months. They're running 24/7 shifts and physically cannot process additional volume. This means that even if silver prices soar to $200, there's a speed limit on how quickly new supply can enter the market. The pipeline is clogged, the bottleneck is real, and cannot be easily expanded. When markets begin to understand that immediate physical silver is scarce while paper promises are abundant, a phenomenon called backwardation emerges. Spot prices trade higher than futures prices. This is the ultimate signal of a physical shortage. It means traders are willing to pay a premium to possess metal today, rather than accept a contract promising delivery next month. Why would they do this? Because trust in the just-in-time delivery system has completely shattered. For 40 years, global supply chains operated on efficiency principles pioneered by Japanese manufacturing. Companies didn't hold inventory. They ordered exactly what they needed exactly when they needed it, minimizing storage costs and capital tied up in materials. That era died Monday morning. We're now entering the era of just-in-case inventory management. Companies are going to start hoarding, building substantial stockpiles as insurance against supply disruptions. Instead of maintaining 2 weeks of silver inventory, electronics manufacturers might decide they need 6 months of buffer stock. If every major industrial consumer triples their inventory targets simultaneously, global demand doesn't increase by 5%. It doubles overnight. That's the demand shock rippling through markets right now. It's an inventory rebuilding cycle happening simultaneously with a currency crisis and a geopolitical realignment. The perfect storm. The smart money moved first, quietly accumulating positions while prices were suppressed. Industrial money moved second, desperately securing supply before production lines faced shutdowns. Now the public is arriving. And when the public arrives during a financial mania, the entire character of the market transforms. Over the weekend, Google search volume for the phrase "how to buy silver" spiked by over 300%. Social media platforms are exploding with discussions. The narrative is shifting from "silver is a dead asset" to "silver is the new Bitcoin," which is shorthand for a momentum play that could generate transformational returns. This narrative shift is extremely dangerous for institutions trying to suppress prices, because retail crowds are fundamentally price insensitive. When a hedge fund manager allocates capital to silver, he performs sophisticated valuation analysis. When a retail investor buys during a mania, he's buying momentum and story. He sees the price jump from 80 to 84 and his psychology screams, "I'm missing out." So he logs into his brokerage account or drives to his local coin shop, bringing a wave of capital that doesn't care about overbought technical indicators or resistance levels or prudent position sizing. But here's the structural problem. The retail silver pipeline is tiny. The consumer market, coins and small bars and rounds, represents a small fraction of overall supply. The vast majority of silver exists as 1,000-ounce industrial bars traded between refineries, manufacturers, and institutional vaults. When Samsung and Tesla vacuum up those industrial bars to manufacture products, there's no feedstock remaining for private mints to create retail products. The supply chain for consumer silver products breaks down completely. We're already witnessing signs of breakdown at the dealer level. I checked inventory at 3 major online bullion dealers Monday morning. The messages are remarkably consistent. Delayed shipping, high volume alert. And in some cases, the most ominous phrase a buyer can encounter: call for pricing. Why would dealers instruct customers to call for prices instead of listing them on their website? Because volatility has become so extreme that automated pricing software cannot keep pace with market movements. If they sell you a coin at $85 and the spot price gaps to $90 5 minutes later, they lose money on every transaction. So they disable automated sales and manually negotiate prices with individual buyers. Or they simply stop selling entirely until markets stabilize, which might not happen for weeks or months. This creates a phenomenon that traders call unobtainium, something that theoretically exists but cannot be obtained at any reasonable price. The screen might display $82.79, but try actually purchasing physical silver at that price. You cannot. Dealers are charging premiums of $15, $20, even $25 over the spot price. This means the real street price, what you actually pay to hold metal in your hand, has already crossed the $100 threshold. The disconnect is complete. We now operate in 2 parallel markets. The paper market on the COMEX, where banks trade digital contracts back and forth to establish an official price, and the physical market on the street, where actual metal changes, hands at massive premiums, because there simply is not enough supply to meet demand. This brings us to what I call the ETF trap, and it's critically important that new investors understand this. When the general public becomes excited about silver, most people don't purchase physical metal. It's inconvenient. You need secure storage, you pay shipping costs and premiums, you can't liquidate instantly with a mouse click if you change your mind. So they open their stock trading application and purchase shares of a silver ETF like SLV, believing they're participating in the squeeze and supporting higher prices. They think they own silver. They're completely wrong. Buying a paper ETF during a physical shortage is like purchasing a ticket to a concert after the venue has already burned to the ground. You possess the ticket, but there's no actual show. The authorized participants who manage these ETF structures are often the exact same bullion banks holding massive short positions. When billions of dollars flow into an ETF, those banks use the fund's complex legal structure to lease metal, rehypothecate it, using the same physical metal as collateral for multiple overlapping obligations, and continue suppressing prices. You're essentially handing your capital directly to the entities actively fighting against your interests. You're funding your opponent. The Reserve Bank of India understands this perfectly. That's why they purchased physical gold, not a gold ETF. Chinese industrial buyers understand this. That's why they're demanding physical delivery in Shanghai, taking actual possession rather than accepting paper promises. Retail investors need to internalize this lesson immediately. If you cannot physically hold it in your hand, you don't truly own it. This principle has never been more critical than right now, January 12th, 2026. So what happens next in the retail sector? As news of the shortage spreads through social media and mainstream financial press, the panic will accelerate. We'll likely witness lines forming outside coin shops in major cities. We'll see delivery delays stretch from 2 weeks to 2 months or longer. We'll watch premiums expand until the paper price becomes completely irrelevant to actual transactions. This dynamic places the COMEX in an impossible position. If the street price reaches $110 while the COMEX price quotes 82, any trader holding a warehouse receipt will immediately stand for delivery. They will extract metal from COMEX vaults at $82 and sell it on the street for $110. That's a $28 profit per ounce with essentially zero risk. This arbitrage mechanism systematically drains exchange inventories until vaults hit zero, and those vaults are already bleeding. The registered category, silver that's actually available for immediate delivery as opposed to merely stored at the facility, has been declining for years. It currently sits at historic lows. The 10% price surge we witnessed this week represents the market sensing the bottom of the barrel. It's the collective realization that at $80, there's no metal left. So the price must rise to 90. If there's no metal at 90, it rises to 100. The process continues relentlessly until someone somewhere becomes willing to sell their physical holdings, perhaps eventually melting down family heirlooms when prices reach levels that overcome emotional attachment. But who's actually selling right now? Are you selling? I seriously doubt it. If you've held physical silver through years of bear markets and sideways grinding action, if you understand the fundamental drivers we've been discussing, you're not going to liquidate your insurance policy just because the house caught fire. You're going to hold it even tighter. So we have massive new industrial demand, panic buying from retail investors, discovering the story, and a legacy holder base that absolutely refuses to sell. This is the precise formula for a vertical melt-up. But I must repeat the warning from earlier. Do not use leverage, do not trade silver on margin, do not use borrowed money. The banks know the retail crowd has arrived. They know new buyers are emotional and potentially overextended. They will engineer flash crashes, sharp $10 drops in 10 minutes during low liquidity periods, specifically designed to trigger stop losses and margin calls. If you're trading on margin or using leverage, you will be wiped out. You might be completely correct about the long-term direction, but lose your entire account before reaching the ultimate destination. If you own physical metal, a flash crash means absolutely nothing. It's just noise. Your ounce of silver is still an ounce of silver. It still conducts electricity. It still stores value. It still exists completely outside the banking system. The retail tsunami represents the final wave. Smart money arrived first, quietly accumulating. Industrial money came second, desperately securing supply. Public money is flooding in now. When the public arrives, volatility explodes exponentially. We're going to witness trading days where silver moves $5, $10, possibly $15. The ranges are expanding dramatically. The stability of range-bound markets is completely gone. We've entered the mania phase. So where does this ultimately end? Is $84 the top? Is 100 the peak? To answer that question properly, we cannot measure silver in dollars. As we've thoroughly established, the dollar has become a broken measuring instrument. Measuring silver in dollars is like measuring the length of a bridge using a rubber band. The rubber band stretches, so the bridge appears longer, but nothing fundamental has changed about the bridge itself. Instead, we must examine relative value, specifically the relationship between the two monetary metals, gold and silver. Gold currently trades around $4,580, holding remarkably firm as the anchor of the emerging financial system. Now, consider the gold-to-silver ratio. Throughout monetary history, from the Roman Empire through the U.S. Constitution, the natural ratio of gold to silver was approximately 15 to 1. For every 15 ounces of silver in the Earth's crust, there exists roughly 1 ounce of gold. In the modern era, that ratio exploded catastrophically. It expanded to 80 to 1, 90 to 1, even 100 to 1 during extreme suppression periods. This signaled that silver was being priced as a cheap industrial byproduct rather than a scarce monetary asset. Today, with gold at 45.80 and silver at 82, the ratio stands at approximately 55 to 1. The ratio is collapsing, reverting toward its historic mean. If silver were to simply return to its natural 15 to 1 ratio against current gold prices, where would it trade? The mathematics are straightforward. 4,580 divided by 15 equals $305 per ounce. 305. That's the fair value of silver in a monetary system where gold trades at $4,500. At $82, silver isn't expensive. It's trading at a 70% discount to its monetary parity with gold. This is what traders call the catch-up trade. When gold becomes too expensive for ordinary investors to accumulate, capital naturally flows into silver as poor man's gold, offering substantially more leverage and greater upside potential. This dynamic is precisely why the move to $100 isn't a question of if, but when. Shanghai is already pricing silver at 91. The actual street price for physical metal already exceeds 100. The paper price has no choice but to follow. Economic gravity is absolute. $100 represents a critical psychological barrier. Human beings love round numbers. When silver crosses $100 per ounce, it will trigger a global media frenzy. It becomes a magazine cover story, a viral social media topic, a cultural moment. That's when maximum danger and maximum opportunity coincide precisely. This brings us to exit strategy, because many of you are starting to think about selling. You're calculating the dollar value of your holdings and beginning to feel wealthy. You're imagining paying off your mortgage or purchasing a new vehicle, but you must be extraordinarily careful here. If you sell your silver for dollars, what are you actually doing? You're trading a hard asset that's appreciating for a soft currency that's collapsing. You're jumping off the lifeboat to swim back to the Titanic because the Titanic has a nicer dining room. The dollar is not your destination. The dollar is the casualty of this crisis. We are living through a currency reset in real time. The massive bond sales by central banks signal that the sovereign debt bubble is in the process of popping. When debt bubbles pop, currencies die. History is absolutely clear on this point. In every currency collapse throughout recorded history, Weimar Germany, Zimbabwe, Venezuela, Argentina, those who sold their gold and silver too early regretted it with devastating intensity. They sold for millions of paper units only to discover weeks or months later that a loaf of bread cost billions of those same paper units. So when should you actually sell? When you can trade your ounces for income-producing hard assets. This is what some call the ounces to acres strategy. Don't trade silver for paper currency. Trade it for land. Trade it for rental property that generates monthly cash flow. Trade it for an operating business. Trade it for energy infrastructure like solar installations or mineral rights. Wait for the moment when the mania reaches such extreme heights that real estate prices crash relative to silver. Right now, it might require 5,000 ounces of silver to purchase a decent house in a good neighborhood. At the peak of a historic mania, it might take only 500 ounces to buy that same house. That's the trade. You're swapping one form of generational wealth for another form of generational wealth, bypassing fiat currency entirely. You never convert back into dollars, except momentarily as a transactional medium. But we're not remotely close to that point yet. We're at $82. We're just leaving the launch pad. We're in the early innings of a process that could take months or even years to fully unfold. The week ahead is going to test your psychological resolve. The volatility will be nauseating. Banks will launch coordinated counterattacks, attempting to smash prices down to $75 to trigger stop losses and create panic selling. They'll spread carefully crafted rumors through financial media, rumors of geopolitical ceasefires, rumors of central bank intervention or emergency bailouts, all designed to calm markets and encourage selling. Ignore the narrative noise. Watch the actual fundamentals. Is the Reserve Bank of India buying those bonds back? No. Is Samsung halting battery production? No. Is the Shanghai premium disappearing? No. The fundamentals are locked in. The bridge is burning behind us. There's no returning to $20 silver. That world is gone forever, relegated to history books. We're entering an era of resource nationalism. Countries that produce silver, like Mexico and Peru, will increasingly start hoarding domestic production. Countries that desperately need silver for industrial and military applications, like the United States and China, will compete for remaining supply with escalating aggression, economically, and perhaps eventually through other means. You, the individual investor holding physical metal, are positioned in the middle of this geopolitical struggle, possessing the one tangible asset that everyone wants. Don't let volatility and psychological warfare shake you out of your position. Hold your physical metal, secure your storage, educate your family members about what's happening and why it matters. The great repricing isn't merely about wealth creation, though that will certainly occur for those who understand what's unfolding. It's fundamentally about surviving the transition from a debt-based economic system to a resource-based economic system. The dollar died Sunday night when that Shanghai gap opened and revealed the emperor has no clothes. Price discovery began Monday morning. The future belongs to those who hold physical reality in their hands, not digital promises displayed on computer screens. Stay safe, stay rational. Welcome to the age of real money.